Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune, realtor right here in Greenville. You can find all of my contact information in the show notes if you need a realtor or if you're looking for a team to join because you are a realtor, need some help with your business. Contact me, info in the show notes. And if you need an insurance company, even if you don't need an insurance company, I'm going to recommend to you this show's sponsor, which is Piper Insurance Group. They can help you with all your home, auto, and umbrella insurance needs in South Carolina, North Carolina, and Georgia. They're local to Greenville, but they can help you in 3 different states, and they're independent, meaning they can quote multiple different insurance carriers to bring you back the best possible price possible. And you can just ask them for a free quote. So please go ahead and do that. And it's not just on owner-occupied properties, etc., etc. You can also do fix and flips, ground up new construction, commercial properties, all that good stuff. So reach out to them for a free quote today. And last but not least, please like, rate, review, subscribe, all of those good things with regard to the show. All right. So I have some more Greenville-specific content coming, I promise. Okay. For those of you that listen to this primarily for the Greenville-specific content, I have more of that coming. Okay. But there's just been a lot of different things going on. And quite frankly, those things deserve, in my opinion, to be covered. Now, I'm recording this. The news cycle right now is so fast. I mean, I can record something and it become obsolete very, very quickly. So I'm recording this on Sunday, February the 2nd. I don't know if I've ever recorded an episode on a Sunday before, but I've got a very busy week coming up here. I'm going to be going to Columbia for a couple of days this upcoming week for a conference that I've been to a few years in a row now. It's a political, it's about our political advocacy regarding private property rights, things of that nature. And so I kind of have to plan everything around that. I have to really think ahead to prepare, when I've got a week where I'm missing a few days. I have to do everything like way beforehand. So here we go. That's what I'm doing right now. But long story short, there's obviously been a lot happening. A lot of headlines right now about different, Trump tariffs, tariffs against Canada, tariffs against Mexico. We've talked about this a little bit on the show, but I want to explain this real quick, okay? Because I get questions about this all the time, apparently from people that aren't listening to the show, or maybe they're not listening to the part where I get into this. Here is the concern that people have when it comes to Trump tariffs, okay? The Trump tariffs increase the costs of things, right? Those tariffs don't inherently cost, they're not an inherent cost to Mexico or Canada, right? Not inherently. They are essentially a tax that then gets imposed on the end buyer, which is if you're a buyer of avocados and your avocados come from Mexico and they're tariffed, then they're just going to be marked up by that tariff amount, okay? Now, the confusion that people have is, well, how does this help the American people? Well, it could result in more favorable trade agreements, or, it could result in things coming, for instance, manufacturers coming over to the U.S., like Trump, for instance, mentioned tariffing Taiwan in order to have them move some of their operations over to the United States. Those are just some examples, but in the short term, usually tariffs mean inflation because the prices go up, and then inflation is what the Fed is looking at to determine what the Fed does with rates. And then if the Fed were to, for instance, not reduce rates this year, or if they were to, God forbid, go up on the Fed funds rate this year, then that would result in mortgage rates probably coming up from where they are. So it's all interconnected in a lot of different ways. Now, here's what we don't know. We don't know how long these tariffs are going to actually be in place. We don't know if they'll get renegotiated. Trump, in his first term, way back when, made a lot of threats, even said we're imposing tariffs today, and then there was a last-minute renegotiation that happened that resulted in those tariffs not happening to the extent that they were expected to. Also, understand this, that economists, when they say that tariffs cause inflation, I think, there's a lot of support for that, but there's a lot of economic modeling going on. And if we know one thing, if there's one thing that we've learned from the past 3 years, is that economic modeling is really, really difficult. So difficult that the Federal Reserve has functionally said, we're not really relying on our models anymore. The central bank of the United States can no longer trust their own models. That is something to keep in mind as well, because, you'll hear people say, this is definitely going to happen as a result of tariffs. And then you'll hear people on the opposite end of the spectrum argue the exact opposite. And the reality is that nobody knows who is going to be right at the end. But there are some things that we need to think about from the standpoint of real estate, and specifically mortgage rates, right? Everything right now hinges on mortgage rates. Mortgage rates is what's causing prices to stall out. Mortgage rates are what's causing buyers to not be able to get in the home that they want, that they wish that they could afford, that they could have afforded a few years ago. Everything comes down to mortgage rates. So anything that could cause mortgage rates to go up or even down is something to look at. So I've already discussed the scenario where tariffs potentially cause mortgage rates to go up, right? Because the Federal Reserve potentially has to increase their own rates, which they are trying to decrease at the moment. If they were to reverse course, and if they were to start seeing inflation come into the data, guess what? You're going to start to hear some really hawkish things coming from the Fed. And what that's going to do, the end result of that is going to cause the bond market to kind of slow down. And then that causes treasury yields to go up. And then that causes mortgage rates to go up. I've told you guys this many, many times. If you want to look at where the 30-year fixed rate mortgage is, look at where the 10-year treasury yield is going. That's the bond market, okay? Just look at where that is. The 30-year fixed rate mortgage and the 10-year treasury, they follow each other. They follow each other very, very closely. And so that's something that we have to look at closely. But that's not the only potential outcome, right? There is the potential outcome that these tariffs don't cause substantial inflation, right? He's not tariffing our entire economy. We don't get every single thing from Canada. We don't get every single thing from Mexico or Taiwan or whatever. There are a lot of potential outcomes. The tariffs that Trump did in 2018, right? He didn't do them in 2016. He waited until 2018. Those tariffs did not substantially impact inflation. They did not substantially impact rates. Now, what Trump is proposing right now is more than what he did last time. So we can't just automatically say, well, they didn't cause inflation last time, they're not going to this time. No, it's very possible that they do this time and cause rates to go up. But it's also possible that maybe they don't. Maybe these economic models aren't accurate, as I've already said. There's also a scenario in which mortgage rates come down as a result of I would say this can't just be the result of the tariffs, but just what's happening broader in our economy. But there is a decent chance. There's some economists that I follow that really think that if these tariffs go through, that it increases the likelihood that we go into a recession within the next year dramatically. Okay? The Fed thinks that up until recently, the Fed was pretty confident that we had kind of evaded the recession risk. But there are some people now that are, sounding the trumpet, sounding the horn that this could have aftershocks of a recession. Well, guess what? If we had a recession, then that would mean that the Fed would be then reducing the Fed funds rate, most likely, in an effort to stimulate the economy, right? If we went into a recession, inflation would no longer be the concern. Then the recession would be the number one concern. And the way the Fed responds to that is by lowering rates. Quantitative easing, or what some people like to describe as printing money. It's all functionally the same thing, right? No matter how many different words you use, we're all talking about the same thing. And what happens when that happens is mortgage rates come down. So those are, at the very least, 3 different scenarios that could happen. We could see mortgage rates kind of stay where they are. I'm going to get to that in a second. We could see mortgage rates go go up. We could see them go down. Literally, everything's on the table. It all just depends on the aftershocks of these tariffs. And quite frankly, nobody knows right now what those aftershocks are going to be. All right, let's look at the 10-year Treasury yield. If you're watching on YouTube, I'm going to show you something. Show you a little something. Uh-oh. So I changed computers recently, and I just realized that my Zoom settings are not what I thought that they were going to be. So I'm going to try something here that may or may not work. All right, desktop 1. Let's see if this... I apologize, guys. Allow Zoom Workplace to share your screen. All right, hold on. I've got to allow this. Isn't this so much fun? Well, unfortunately, changing to a different computer messes up for me. So you guys are not going to be able to look at the nice little chart that I came up with. This is very frustrating. Zoom in general. So I use Zoom for recording on here, and usually it works out quite well. But here we go. I want to share a screen, and it doesn't want me to do that. Screen sharing and recording. Yes. Oh, actually, I may have just fixed it. But it may not let me do this until... Oh, hold on. Okay. I think... Listen, I apologize. I try to be professional about this, but I also really try to get you guys the content every week, and I did not... I've been working on this new computer for several days now, and I have not had this happen the entire time I've been working on it. So I apologize for that, and hopefully that won't happen again. All right. If you're looking on YouTube, you can see it. Thank you for enduring all of that. I have the 10-year Treasury yield that is current, what we have right now. Right now it's sitting at 4.543%. That's the 10-year Treasury. And then, of course, that impacts where the 30-year fixed rate mortgage is. The 30-year fixed rate mortgage is now at 7.05. So basically, the difference is about 2.5%, right? Or 250 basis points, loosely speaking. There are times when that spread, as they call it, is lower. There have been times where that spread has been closer to 150, for instance. If the spread were 150 right now, the average mortgage rate per Mortgage News Daily would be around 6, okay? But right now, it's closer to a 250 basis point spread, and as a result, we have average rates per Mortgage News Daily in the low 7s. But here's what I want to point out to you guys about what we're seeing with the 10-year Treasury. We're seeing that it's reaching a consistent ceiling and floor that it's having a hard time punching through, okay? Now, what I'm showing currently, if you're looking on YouTube, is the 10-year Treasury from the past year. And what you'll see from the past year is that it has not been able to. I've got a red line at the top of the graph, and the 10-year yield has not been able to punch through 4.8, right? It came real close right around when Trump was elected. It went above 4.75, but since then, it has come back down. It's tapered back down since then. It went up over the summer as well. It went into the 4.7s over the summer, but it never punched through 4.8. And I've heard this from a few different sources, is that basically there are so portfolio managers have to determine when Treasury yields are high enough that it makes sense to invest in bonds, right? That's pretty normal. I've heard for some that 5% is that number. But what I think is happening is that others have kind of leapfrogged those bigger portfolio companies, and they've got the number around 4.8. So I think once we get close to 4.8, that's when we see people start to buy bonds, And then you see those treasury yields start to, the 10-year treasury start to come down a little bit. So I actually believe that until we see some major concerns, right, with regard to specifically inflation, I think that we're going to have a hard time punching through 4.8. So I think it's pretty safe to say that we're going to be below 4.8 on the 10-year treasury for the entire year, barring some kind of crazy, all of a sudden tons of inflation comes into the data. And so with a 250 basis point spread, you can roughly assume that mortgage rates, if I'm right on this, mortgage rates should stay below 7.5 per Mortgage News Daily for the entire year. Okay? Now let's look at another one. Now we're going to look at the floor, what I'm calling the floor for the 10-year treasury. And this one I actually find to be a little bit more interesting. All right, pull that up here. So here's the floor. Now, this is a 3-month chart that I'm looking at if you're following on YouTube. And so you can see basically once we hit December 7th, we started to see treasury yields going up. And this was a result of concerns about some of the messaging that President Trump was saying that made people concerned. Okay, there might be inflation happening, combined with strong jobs data, combined with weak inflation data, or strong inflation data, bad inflation data, I guess is what I should say. All of these things kind of combined in the month of December, early December, to cause the 10-year treasury yield to soar until it reached, again, that top part, which I said it came real close to 4.8 and then came back down. And so what I'm looking at, what I'm most interested is that since December, let's see here, roughly December 16, 17, something like that, the 10-year yield has tried to go below 4.5. And that's where I have a red line on here. It's tried to go below 4.5 multiple times and has not been able to punch below that number. And what I think that 4.5 number is, I think that 4.5 number is the Trump number, right? This is until we know what Trump is going to do, we're going to keep that number above 4.5. So the bond market right now is looking at treasury yields essentially between 4.5 and 4.8 until something tells them to do otherwise. What could tell them to do otherwise? Again, if inflation data comes in, starts to come in really hot, you're going to see a bond sell-off. You will see the 10-year treasury skyrocket. If inflation data starts to get more respectable, starts to show signs that we've maybe gotten over that last little hump, or we're making a little bit of progress, because that's what's happened. The Federal Reserve made some pretty good progress on inflation the past 3 years, but it just hasn't been able to get over that last little hurdle to try to get us to 2% that they're so obsessed with. And so right now the market, in order to go below 4.5 in terms of treasury yields, I think that the market is really wanting to see that either the economy is slowing down or inflation is slowing down, perhaps both of those two things combined. And so here's what I'm looking at. I am expecting right now, until things actually change, until we get data that shows that there's something changing, or unless the Federal Reserve comes out and says, hey, things have changed, we're going to start raising rates, or we're going to start dramatically dropping rates, we're concerned about a recession. Till something like that happens, I think that we're going to see this. I'm not going to predict that we're not going to go above 4.8 or below 4.5, but I think what you're going to see is that there's going to be these temporary moments where we dip below 4.5 and then immediately go back above. We might dip above 4.8 and then immediately dip back below. And so that's going to have a direct effect on mortgage rates. By the way, none of this is investment advice. I'm just telling you what I think is happening based on what I've heard. So if we stay above 4.5, that basically gives us a a floor of mortgage rates being around 7%. Again, the spread can tighten, the variety of ways that can happen. And if the spread tightens, we could see mortgage rates, go to 6.8, 6.7, something like that. But at the moment, the spread has been pretty stable. In fact, I'll show you on here the Mortgage News Daily numbers so you guys can see that as well. All right, here's the Mortgage News Daily numbers. So you can see here when the 10-year yield went up, had that spike where it went up around 4.8. Mortgage rates followed. Per Mortgage News Daily, they hit about 7.26. And then they basically have been coming down pretty steadily since then. Now, the past week, they've been hovering in the low 7s. But they have been coming down a little bit. And so a lot of that does have to do with that spread between the 10-year yield and the 30-year fixed rate mortgage tightening up a little bit. But at the same time, we're not seeing, any major, we've not seen any really major fluctuations really the past 2 weeks. So we will keep track of this, but I am basically expecting what we see basically since October is that since the middle of October, we've seen rates basically hovering between 6.6 and 7.25. And I feel like it's really, really realistic right now, barring, again, something dramatic happening in the broader economy and that being publicized in a big way by the media, by the Federal Reserve, et cetera, et cetera. Barring something like that happening, I think we're just going to see mortgage rates in this bandwidth right now. 6.6, we'll just call it 7.3. That's what we can expect for this data. Now, that doesn't mean that's what you're going to get if you apply for a mortgage. And in fact, you can see if you're looking at on YouTube, there's actually 3 indices that are on here. We have the Mortgage News Daily one, which I like because it's an aggregator. But then you also have the Freddie Mac Weekly Survey. That can lag a little bit. You've got the Mortgage Bankers Association weekly survey and the FA monthly survey as well. Those are all reflected in this data, and you can see that the Mortgage News Daily one is the highest out of all of them. The other ones are, in fact, lower, and that's simply a result of the fact that, again, not everyone is going to qualify for the same rates. I'm really overly simplifying things here. But a lot of people, if Mortgage News Daily says the rate is 7.05%, like it does today, a lot of people that have good credit scores, 700s, 800s, good income, all of that, they're going to be able to get a more attractive rate than that. But you've got to talk to your lender about that. I am not a loan officer, so I can't help you with that. But I can connect you with good lenders who can. And I think that's a good way to tie a bow on the show, right? Connect with the lender. If you're interested in buying, these rates scare you, see what they can offer. There are programs out there. There's ways you can buy down rates. There's all sorts of creative ways in order to make your monthly payment more attractive. There are loans that eliminate PMI. I have a client right now attempting a mortgage assumption. That's something maybe I'll do a show on a little bit later. Getting a mortgage at 2.99%, which probably will never see a 30-year loan at 2.99% again. I hope not, because that would mean our economy's in the trash, most likely. But there are some creative ways in order to get the rates a little bit lower than what you see on these numbers. So talk to a loan officer. If you need one, please reach out to me. I can connect you with a lender. My contact information is in the show notes. Piper Insurance Group, also in the show notes. Reach out for a free quote today. And please like, rate, review, subscribe, all those good things. And we will talk again next time.